When you invest in an active ETF, what exactly are you paying for? What happens behind the scenes? Let's unpack how these funds are managed. I'm Ted Malcolm, Head of UK ETF Distribution at JPMorgan. At the core of an active ETF is a team of investment professionals, typically led by a portfolio manager, supported by analysts, economists, and risk specialists. The goal is straightforward: deliver better outcomes than a passive benchmark through selective investing. That starts with information. The team monitors macroeconomic trends such as inflation, interest rates, or GDP growth, sector dynamics, for example, how rising energy prices might benefit some firms but hurt others, company fundamentals, things like earnings growth, debt levels, or management quality. An active ETF might apply a top-down strategy, starting with global economic forecasts, then identifying sectors likely to benefit, then picking stocks within those sectors. Or it might use a bottom-up approach, where analysts focus on individual companies that look undervalued or well-positioned regardless of macro trends. The portfolio itself is actively managed, meaning holdings are reviewed and adjusted regularly, risk exposures are monitored and diversified. Poorly performing positions can be reduced or sold entirely. Let's bring this to life with a simple example. Imagine a fund that focuses on global equities. At the start of the year, it may be overweight in US tech and underweight in European financials. But as inflation data shifts and interest rates rise, the manager might decide to rotate into more defensive sectors, like healthcare or utilities. This active rotation is like a chef, choosing ingredients based on what's fresh, in season, and suited to that dish, compared to a passive fund, which follows a fixed recipe no matter the conditions. In practice, this work involves constant analysis, model building, scenario testing, and crucially, judgment. At JPMorgan Asset Management, portfolio managers often work in tandem with dedicated teams across sectors and regions, combining quantitative tools with fundamental research. It's a collaborative, iterative process. The goal? To stay ahead of market moves, manage downside risk, and seek long-term outperformance compared to traditional index tracking approaches. But it's important to remember, active management isn't a guarantee. Markets are complex and performance can vary. What matters is understanding how these products are constructed and whether that process aligns with your expectations as an investor.